Imagine this. It's 2025, and the world as we know it is teetering on the edge. Currencies are inflating faster than politicians can print excuses. Supply chains are fracturing like old fault lines, and whispers of food shortages echo from the heartland. While you're glued to headlines about gold spiking to $4,000 an ounce or Bitcoin flirting with six figures, the real power players, the billionaires who built empires from nothing, aren't scrambling for those shiny distractions. No, they're quietly cornering something far more primal, something that could dictate survival when the lights flicker out on our fragile financial system. What if I told you they're not chasing digital dreams or precious metals? They're hoarding the very foundations of life itself: land, water, and the hidden rights that control them. And the scariest part? You won't see it coming until it's too late. Let me pull back the curtain on this shadowy game. I've spent years digging into the underbelly of global markets, tracing the moves of the ultra-wealthy through leaked filings, satellite maps, and off-the-record sources. What I've uncovered isn't just investment trends. It's a blueprint for the collapse. While retail investors pile into the same overhyped assets the rich dumped years ago, these titans are positioning for a world where money means nothing, but control over essentials means everything. We're talking about three overlooked assets: prime farmland engineered for scarcity, underground water empires, and the invisible legal chains that bind it all. These aren't sexy stocks or trendy cryptos. They're the boring behemoths that will outlast any boom or bust. And in 2025, with droughts ravaging the West and climate volatility spiking crop failures, their value is exploding. Let's start close to home, right here in the United States, where the soil itself is becoming the ultimate safe haven. Picture vast stretches of earth, not the dusty plots you see in old westerns, but meticulously selected acres primed for an uncertain future. This is where he enters the story: Bill Gates, the tech visionary turned agrarian overlord. You might know him for software revolutions, but in the shadows of his Cascade investment empire, he's been on a decade-long buying spree that dwarfs anything in Silicon Valley. By 2025, he controls nearly 275,000 acres scattered across 18 states, an expanse equivalent to 430 square miles, larger than the sprawl of Los Angeles itself. That's not a hobby farm. That's a strategic fortress. But here's the intrigue. Gates isn't grabbing just any dirt. His acquisitions follow a chilling pattern, like a chess master anticipating checkmate. Dive into the map, and you'll see clusters in the Mississippi Delta of Louisiana, over 69,000 acres of black gold soil, the richest topsoil in America, built up over thousands of years from river sediments. This isn't recreatable. It's a geological gift facing erosion from climate shifts. What makes it irresistible? Unlimited water from the mighty Mississippi and underlying aquifers that laugh at droughts. And the kicker? A growing season that stretches year-round, allowing double harvests of soy and corn when other regions wither. Shift east to Arkansas, where another 47,000 acres hug the Arkansas River. Prime rice and soybean belt, the heart of America's breadbasket. Water-intensive crops thrive here, fed by rivers that won't run dry anytime soon. Then Nebraska, thousands of acres perched above the Ogallala Aquifer, that colossal underground reservoir spanning 8 states. It's depleting fast elsewhere. But Gates targets the deepest, most replenishing pockets. Insurance against the day when taps run dry across the plains. Washington State? 17,000 acres in the Columbia Basin, a watery paradise for wheat, potatoes, and exports straight to Asia via Pacific ports. Florida rounds it out with 14,000 acres of citrus groves and cattle land, basking in endless sun and aquifer access. Why this obsession? It's not nostalgia for the soil, it's foresight into famine. Historically, empires rose and fell on control of arable land, from the pharaohs damming the Nile to the Dust Bowl's lessons in the 1930s, when overfarming turned the Midwest into a wasteland. Gates knows the patterns. As global warming squeezes viable farmland, UN projections say we'll lose 20% by 2050. His holdings become priceless. No more relying on volatile imports from unstable regions. This is self-sufficiency at scale. And quietly, through LLCs and trusts, he's shielded it all from prying eyes. Imagine the suspense. While you fret over stock dips, he's securing the seeds of tomorrow's economy. But land alone is half the equation. To truly dominate, you need the lifeblood that makes it bloom. Water. Enter the second asset, one so arcane it flies under even the sharpest radar. Water rights. These aren't bottles on a shelf. They're legal deeds to siphon from rivers, lakes, and aquifers, tradable like stocks, but regulated like national secrets. In a parched America where the Colorado River is shrinking and California rationing hits farms hardest, owning the flow is owning the future. Our next player? He was the wildcatter who struck oil black gold in Oklahoma. But T. Boone Pickens saw the real rush coming decades ago. By the 2000s, he'd pivoted from fossil fuels to something more enduring. Mesa Water, his private aquifer empire in the Texas Panhandle. Drawing from the same Ogallala that Gates taps upstream, Pickens amassed rights to billions of gallons, enough to supply a city of 300,000 for years. He didn't stop there. He bottled and sold it, but the real play was holding the rights amid escalating scarcity. Remember the 2011 Texas drought? Crops died, prices soared, and Pickens's water became liquid gold, fetching premiums in desperate deals. This isn't new. Water wars trace back to the West's founding. The 1901 Reclamation Act birthed federal dams, but it also sparked private battles. Think the Owens Valley Aqueduct that starved Los Angeles' neighbors in the early 1900s, fueling Hollywood's noir tales of greed. Pickens, ever the opportunist, bought low during booms and held through busts. By 2025, with wildfires scorching reservoirs and population booms straining supplies, his model has inspired copycats. Billionaires are snapping up riparian rights along the Rio Grande and groundwater permits in Arizona, often through opaque entities to dodge public backlash. The hidden mechanism? Seniority. Older rights trump newer ones in court, so they're grabbing grandfathered claims from aging ranchers. Suspense builds as pipelines snake across maps. Will it quench thirst or monopolize it? Now, escalate the stakes. These aren't isolated buys, they're intertwined. Farmland without water is dust, and water without land is wasted potential. Enter the third asset, the stealthy linchpin. Proprietary water infrastructure and allied cropland in arid strongholds. This is where they come in, the Resnicks, that power couple behind the wonderful company, turning California's sun-baked valleys into nut-fueled fortunes. Stuart and Linda Resnick don't just own land. They command 120,000 acres of almond and pistachio orchards in the San Joaquin Valley, the most water-hungry crops on Earth. But their edge? A web of private wells, desalination tech, and secured allocations from the State Water Project. Rights bought or lobbied during the 1970s crunch. The Resnick story drips with intrigue. Starting from humble citrus roots, they built an agribusiness behemoth. But the real coup was during the 2008 financial crisis when foreclosed farms went cheap. By 2025, amid mega droughts that have idled millions of acres, their setup shines.
They pipe in Colorado River shares via convoluted deals and invest in drip irrigation that squeezes every drop. Historical echoes? The 1920s California water grabs that birthed mega farms, displacing communities in a rush eerily like today's. The Resnicks mask it as sustainability, ads touting wonderful efficiency, but filings reveal relentless expansion. Their orchards export billions in nuts to China, buffering against domestic squeezes. When federal subsidies falter and global demand surges, who controls the taps wins. Tie it together, and the financial implications hit like a market crash. These assets aren't volatile. They're anti-fragile. Gold rusts in storage. Bitcoin crashes on regulation. But farmland yields 5 to 10% annually in rents and crops. Water rights trade at 20 times premiums during shortages, and infrastructure like the Resnicks generates steady royalties. Valuations? Gates's portfolio alone is worth $700 million. But in a crisis, it could 10 times as food prices double. Think 2022's Ukraine war spiking wheat to records. Hidden costs? Environmental blowback. Overpumping aquifers could trigger sinkholes, sparking lawsuits. Yet the ultra-wealthy bet on resilience. When the dollar devalues and hyperinflation hits, as in 1920s Weimar or 2000 Zimbabwe, tangibles rule. Why does this matter now, in 2025? We're at the inflection point. NASA's data shows aquifers dropping 20 feet a year in key basins. USDA warns of 30% farmland loss from heat waves by 2030.
Geopolitics amps it. Russia's grain weaponization, China's farmland grabs in Africa. The U.S. can't import its way out. Supply chains? COVID exposed them. Now climate fractures food lines. Billionaires aren't waiting. Filings show a 40% uptick in ag land buys since 2020. For you, the average viewer, it's a warning. Diversify beyond walls. ETFs like Farmland Partners, FPI, or Water Funds, CGW, offer slices without billions. REITs tied to aquifers, even crowd-funded groves, exposure starts at thousands, not trusts. As I stand on the edge of this revelation, reflecting on the quiet conquests of Gates, Pickens, and the Resnicks, one truth lingers like a gathering storm. Our financial system, built on debt and digits, promised abundance, but delivered fragility. These visionaries, or vultures depending on your view, see the cracks widening. They're not just investing, they're insuring against apocalypse. The question isn't if the system breaks, but who controls the rebuild? Will it be the hoarders of earth and water? Or can we, the overlooked majority, claim a share before the gates close? The clock's ticking. Dig in or get left in the dust. Imagine this. It's 2025, and the world is parched. Crops wilt under relentless sun, cities ration every drop, and billionaires like Bill Gates are silently amassing fortunes not in stocks or silicon, but in the one resource we all crave: water. But here's the secret they're banking on. When the taps run dry, those who control the rights to the flow won't just survive, they'll dictate the future of food and life itself. What if I told you that the richest minds in America aren't fighting over oil anymore? They're cornering the market on H2O, and it's happening right now, under our noses. Let me take you back to the heart of America's breadbasket, where the stakes are higher than ever. We're talking about the vast farmlands stretching across the Midwest and West. Places where soil whispers promises of abundance. But as I've dug deeper into these deals, I've uncovered a pattern that's both genius and chilling. Bill Gates, the tech titan turned farmland mogul, isn't just snapping up acres for nostalgia. No, his moves are calculated, laser-focused on lands that check every box for long-term dominance. Picture this: superior soil that defies replication, reliable water from ancient aquifers or mighty rivers, and now, the third pillar: climate zones that stretch the growing season year-round or cradle premium crops like grapes and nuts. These aren't random buys. They're blueprints for resilience in a world on the brink. I remember the first time I crunched the numbers on Gates' portfolio. It hit me like a drought warning. He's not planting seeds today for tomorrow's harvest. He's positioning to command the entire food chain when global systems crack under pressure. Think about it. Pandemics, wars, climate chaos, these have exposed how fragile our supply lines are. Gates sees the breakdown coming, and his land grabs are insurance policies for control. But the real intrigue? He's not slowing down. Just last June, in the sweltering heat of 2025, his investment arm shelled out a staggering $131.4 million for 8,800 acres in Benton County's Horse Heaven Hills, Washington. That's $16,000 an acre, 4 times what your average American farmland fetches, hovering around $3,000 to $4,000. Why overpay like that? I chased the deeds and satellite images myself, and what I found was a jackpot disguised as dirt. This slice of earth isn't just fertile, it's wired for efficiency. Massive crop circles etched into the landscape, fed by pivot irrigation systems humming like clockwork. Beneath it all, direct taps into deep aquifers, a climate tailor-made for high-yield bounty, and, here's the clincher, bundled mineral and water rights. Those rights? They're the invisible gold veins running through every deal. Gates isn't buying soil. He's securing the lifeblood that makes it sing. And as I peeled back the layers, I realized this is just the tip of a much deeper iceberg. Billionaires aren't hoarding water itself. They're collecting the keys to unlock it. Water rights. These legal claims to extract and divert could eclipse every other asset in the 21st century, turning scarcity into staggering wealth. Now, let's pull the curtain on how this shadowy game really works, because most of us treat water like it's infinite, a public good flowing from the sky. But in the American West, where half the nation's food is grown, it's anything but. I've pored over dusty legal tomes and court filings from the 1800s, and the story starts there, in the lawless rush of pioneers. Water rights operate under prior appropriation, a brutal first-come, first-served doctrine. Imagine gold rush miners staking claims. The earliest users, often grizzled ranchers and farmers from the 19th century, lock in senior rights. In dry times, they drink first. Full allocation, no questions. Latecomers? Junior holders scrape for leftovers, which can mean zilch when reservoirs shrink. What makes this explosive is the separation. You can own sprawling land, but zero say over the water crossing or pooling below it. Rights trade like stocks, bought, sold, leased, independent of the deed. I traced deals back decades, and the aha moment came when I saw how scarcity flips the script. In a region choking on demand, from booming cities to thirsty farms, senior rights become priceless leverage. Hold them, and you don't just get water. You set the terms, the price, the flow. It's not about quenching thirst. It's about who pulls the strings when the well runs low. This isn't theory. It's a blueprint billionaires have followed for years, quietly building empires while the rest of us fill our bottles at the store. Take T. Boone Pickens, the Oklahoma oil wildcatter who struck black gold in the 70s and pivoted to something even rarer. In the 1990s, as Texas baked under endless skies, Pickens zeroed in on the Panhandle, a flat expanse atop the Ogallala Aquifer,
one of the world's largest underground reservoirs stretching like a hidden sea from South Dakota to Texas. But he wasn't eyeing cattle or cotton. He assembled a web of senior water rights, enough to pump 65 billion gallons annually. That's the lifeline for a metropolis of 1 million souls. I dug into the sales records, and the payoff is jaw-dropping. In 2011, amid a brutal statewide drought, Pickens flipped a chunk of those rights to 11 desperate Texas cities, Amarillo, Lubbock, you name it, for $103 million. Not a drop moved. Just the permission to extract. At roughly $1.58 per 1,000 gallons, it was a king's ransom compared to municipal rates, mere pennies from lakes or rivers. Pickens pocketed a tenfold return on his bet, and he still holds the lion's share, now appraised north of $500 million. It's not luck, it's foresight. He saw the aquifer depleting, cities exploding, and positioned himself as the gatekeeper. But Pickens was a pioneer in a now crowded arena. Wall Street has smelled the opportunity, spawning firms that treat water like the next crypto boom. Take Water Asset Management, a slick New York outfit that's been prowling Colorado's Front Range. Since the early 2000s, they've scooped up over 2,500 acres along the Colorado River, not for the hayfields, but the embedded senior rights. The dirt? Maybe $50 million in value. The water access? A cool $300 million plus.
Their CEO laid it bare in a 2022 interview I watched on Loop. Buy irrigated land with top-tier rights, tweak the operations for efficiency, drip tech, crop swaps, freeing up surplus allocation. Then hawk the excess to urban sprawl or ag giants gasping for supply. It's arbitrage on life's essence, all above board, turning public thirst into private profit. As I connected these dots, the web tightened around California, the epicenter of it all. The nation's top ag state, feeding the world from its sun-baked valleys. Here, a power couple has elevated the game to dynasty levels. The Resnicks, Stuart and Linda, the brains behind wonderful company. You know their empire. Pistachios crunching in your snack bowl, pomegranate juices promising health in every sip, those sweet mandarins at holiday tables. But peel back the branding, and their true fortune isn't in fruit. It's in the floodgates they control. It started in the 90s when the Resnicks began carving out a fiefdom in the Central Valley, snapping up tens of thousands of acres of prime orchard land. With the soil came water rights, but they hungered for more. I uncovered minutes from 1994 state hearings, tense rooms filled with bureaucrats and lobbyists, while mayors and activists dozed. The Resnicks showed up, sleeves rolled, and the outcome? Game-changing rules greenlighting private water banking. These aren't backyard ponds. They're colossal state-funded reservoirs built on taxpayer dimes to hoard floodwater in plump years and dole it out in lean ones. Capacity? Massive. 1.5 million acre-feet in the Kern Water Bank alone, the crown jewel they commandeered. That's 500 billion gallons, enough to blanket California's farms in salvation or squeeze every grower for a premium. Fast forward to 2025, and the Resnick's grip is ironclad. While droughts hammer the headlines, lakes like Shasta and Oroville shrinking to bathtubs, they release just enough to keep their groves lush, selling the rest at markups that would make oil barons blush. Their strategy? Diversify. Farm efficiently on a sliver, bank the surplus, and lease rights to desperate neighbors or municipalities. It's a closed loop of control, where they decide who thrives and who withers. And as climate models scream hotter, drier futures, their holdings balloon in value, a fortress against the storm.
But why does this matter now, in this pivotal year of 2025? I've spent months mapping the trends, federal reports on aquifer depletion, UN warnings on global food insecurity, and the convergence is terrifying. The West's water tables are plummeting. The Colorado River, lifeline to 40 million, is at 20% capacity. Megadroughts aren't anomalies. They're the new normal. Add population booms, wildfires scorching watersheds, and trade wars choking imports, and you have a perfect storm. Food prices? Already spiking 20% year over year. Billionaires like Gates, Pickens, and the Resnicks aren't reacting. They anticipated, investing billions to own the scarcity. Gates' latest Washington haul? It's primed for when Pacific Northwest rains falter, securing wheat and potatoes for a hungry planet. Pickens' legacy aquifer taps? They'll irrigate Texas metros as the heat climbs. The Resnick's Kern Vault? A drought-proof vault in a state where 80% of water feeds crops, yet farms consume 80% amid urban cries. This isn't just wealth concentration. It's power consolidation. These titans could sway elections with water diplomacy, prioritize their ag empires over public needs, or even export rights amid global famines. Imagine cities bidding against each other, farmers going under, while a handful dictate dinner tables worldwide.
The financial implications? Water rights are the ultimate hedge, rising 15 to 20% annually in hot zones, outpacing stocks or real estate. But for the rest of us, it's a warning. Utilities could triple. Groceries follow. Inequality widens as the elite sip security. As I stand on the edge of one of these vast fields, wind whispering through pivot arms, I can't shake the unease. We've built an empire on borrowed water, and now the bill's due. Gates, Pickens, the Resnicks, they're not villains in a vacuum. They're harbingers. Their plays reveal a system rigged for the prepared, where foresight is the greatest currency. If we're not careful, the thirst won't just be for water. It'll be for justice in a world where access is king. So, what's your move? Stock up on seeds, push for policy reform, or dive into the rights market yourself? The flow is shifting. Better decide before it runs dry. Imagine this. In the sun-baked heart of California, where the ground cracks like a promise broken, a handful of ultra-wealthy players are quietly seizing control of something more vital than gold or oil. It's water, the lifeblood of an entire economy, and they're turning it into their private fortune. What if I told you that by 2030, the billionaires who hoard this resource could dictate the fate of cities, farms, and even nations? Welcome to the hidden war over America's most precious asset, unfolding right now in 2025. Let's pull back the curtain on how this game really plays out. Picture the vast expanse of the San Joaquin Valley, where they've, the Resnicks, gained a stranglehold on the Kern Water Bank, California's crown jewel for storing this essential resource. With room for 1.5 million acre-feet, enough to fill 500 billion gallons, it's not just infrastructure. It's a fortress. But during those relentless droughts that have become the new normal out west, the real power emerges. They don't grow a single crop or drill a well. Instead, they release that stored water to desperate farmers and urban centers, charging premiums that skyrocket like a thriller's plot twist. Billions in profits roll in, all from gatekeeping a public good turned private gold mine. It's not farming, it's financial wizardry, exploiting scarcity to extract wealth from thin air. But they're far from alone in this shadowy pursuit. Rewind to 2021, when an unexpected contender entered the fray: the Church of Jesus Christ of Latter-day Saints. They shelled out over $200 million for 2,000 to 2,500 acres of prime farmland in eastern Washington state, outmaneuvering even Bill Gates's own agricultural empire in a fierce auction. Why would a religious institution dive into dirt like that? Follow the water. That land isn't about wheat or orchards. It's bundled with ancient ironclad rights to the Columbia River Basin, ensuring an endless flow no matter how dry the skies get. Overnight, the church vaulted into the ranks of the West's top agribusiness titans, not for harvest yields, but for the unbreakable leverage of H2O. It's a move that whispers of long-term strategy, securing sustenance for generations while others scramble. And just when you think it can't get bolder, enter the Wall Street sharks. That same year, Crown Columbia Water Resources, a firm backed by deep-pocketed investors, filed an audacious bid with Washington regulators. Their vision? Scoop up private water entitlements across the sprawling Columbia watershed, stash them in state vaults, then flip or rent them out to booming cities and real estate barons. This wasn't some modest play. It could have been the biggest private water grab in U.S. history, reshaping rivers into revenue streams. Public outcry hit like a storm. Farmers rallied, environmentalists sounded alarms, and the plan stalled, suspended amid the uproar. But here's the chilling part. They didn't vanish. Today, in 2025, they're lurking in the background, snapping up rights through bite-sized deals that slip under the radar. No approvals needed. It's a masterclass in stealth, consolidating power one quiet transaction at a time. Now, let's escalate this. Why does this matter? Because the West's water clock is ticking faster than ever. Climate shifts are melting the Rocky Mountain snowpack, the natural reservoir that feeds millions. The Colorado River, lifeline to 4 states, has withered by 20% in the past 100 years alone. Down in the plains, the Ogallala Aquifer, once an underground sea, is draining quicker than it refills, dooming farms to dust. Projections aren't pretty. Supplies shrinking, populations swelling, demands exploding from tech hubs to megacities. In this crunch, water rights aren't just deeds, they're dynasties. The billionaires and funds piling in, figures like T. Boone Pickens in his heyday, or today's institutional giants, get it. They're not betting on rain, they're banking on drought. By 2030, whoever grips these entitlements won't just thrive, they'll eclipse oil tycoons. Oil? You can innovate around it, electrify the world. Water? It's non-negotiable. No drop, no life, no economy. This isn't abstract futurism, it's unfolding in real time, a financial thriller where the stakes are survival. As farmlands morph into liquid assets and rivers become bargaining chips, we're witnessing a quiet revolution. The ultra-wealthy aren't waiting for permission, they're rewriting the rules, turning public heritage into private empires. And it begs the question, in a world parched for solutions, who will quench the thirst of the rest? But hold on. There's a third layer to this billionaire playbook, even more enigmatic, buried in the fine print of global finance. Something so niche that your average investor blinks past it, yet in 2025, the elite are flooding into it like it's the next big wave. I'm talking catastrophe bonds. Cat bonds, for those in the know. These aren't your grandpa's treasuries. They're high-stakes bets on humanity's worst days. And they're surging for reasons that could reshape your portfolio. Let me break it down, step by investigative step. Imagine a sweltering Florida coast where insurers brace for the next monster storm. Hurricanes like Ian in 2022 wiped out billions, overwhelming even the giants of the industry. Back in the day, they'd offload the pain to reinsurers, paying top dollar for a safety net. but capacity's tight, prices are through the roof, so enter cat bonds, a clever pivot to the capital markets. Here's the mechanics, stripped bare. The insurer spins up a special entity, a ghost company if you will, that floats bonds worth, say, $500 million to hungry investors. That cash parks in a fortress of U.S. treasuries, ultra-safe. In return, the insurer funnels a juicy premium to bondholders. Think 5% to 10% atop whatever treasuries yield. If rates are humming at 4%, you're looking at 9% to 14% payouts, a siren call in a low-yield world. The twist? It's all or nothing. No big disaster? Investors cash out principal plus those sweet returns, a cozy, low-drama win. But if hell breaks loose, a Category 5 slamming Florida, racking up over $10 billion in covered damage, the bond activates. Poof. That collateral shifts straight to the insurer for payouts, and investors? They eat the loss, principal vaporized. It's a gamble on calm skies, rewarding the bold with fat yields, while the downside looms like a gathering cloud. You might wonder, who dives into this madness, where one rogue wave could erase your stake? The answer's a who's who of power players, hedge fund titans, pension behemoths, sovereign pots of gold from abroad. Why? The payoff's obscene, and it's blissfully detached from the market's chaos.
No correlation to stocks plunging on bad news or bonds wobbling with inflation. It's pure elemental risk. Nature's fury versus human greed. Scrunch the numbers and the intrigue deepens. Last year, in 2024, cat bonds delivered an average 17.4%. Yes, you heard that right, crushing the S&P 500's modest 7% and dwarfing corporate debt's 5%. Go back to 2023, 19.8%, leaving blue chips in the dust. Now, fast forward to the 2025 turmoil, when tariff tsunamis under the Trump administration tanked the S&P by 15%. Real estate wobbled, gold flickered. Yet cat bonds? They climbed a steady 1%, yields intact. Why the resilience? Simple. Politics doesn't brew tempests. Trade spats don't shatter fault lines. Bear markets don't unleash wildfires. In a portfolio battered by the familiar storms of economics, cat bonds stand as the ultimate hedge, profiting from what we pray never comes, but can't ignore. So why the explosion now in this pivotal year? Climate's rage is no longer a footnote. It's the headline. Wildfires rage longer, floods hit harder, quakes shake foundations, all amplifying the insurance crunch. Reinsurers are tapped out, governments strained, leaving cat bonds as the go-to valve for risk. Issuance hit records in 2024, and 2025's off to a blistering start, with trillions potentially in play as disasters mount. For the ultra-wealthy, it's not just returns, it's foresight. Positioning against a world where act of God events are the new normal. As I reflect on this trillion-dollar chessboard, from water barons damming the future to cat bond cowboys riding disaster's edge, one truth emerges. The financial elite aren't reacting to crises. They're architecting around them. In 2025, with farmlands as fortresses and bonds as crystal balls, we're at a crossroads. Will we let scarcity become their supremacy, or demand a seat at the table? The drops are falling. Decide before the well runs dry. Imagine this. In a world where the stock market can wipe out your life savings in a single tweet, and bonds promise safety but crumble when inflation roars, there's a shadowy corner of finance that's not just surviving, it's thriving. It's a market built on the fury of nature itself, untouched by recessions or booms. And in 2025, as billionaires quietly scoop up these assets, the rest of us are left wondering, what if the real key to wealth isn't in Wall Street's chaos, but in the unpredictable wrath of Mother Nature? Let's pull back the curtain on this hidden world.
Picture me, your guide through the underbelly of global finance, standing in the eye of an economic storm that's raged for decades. While the headlines scream about trade tensions and market meltdowns, I've been digging into something far more primal: catastrophe bonds, or cat bonds, as the insiders call them. These aren't your grandma's treasury notes. They're high-stakes bets against the planet's most devastating forces: hurricanes, earthquakes, floods, that strike without regard for GDP growth or interest rates. In the dead of night, when the economy sleeps, a storm can brew and change everything. And that's exactly why cat bonds stand apart: a fortress in a financial landscape riddled with hidden traps. To understand this, we have to rewind a bit, not to dusty history books, but to the raw mechanics of risk that billionaires like Bill Gates and T. Boone Pickens have long mastered. These aren't the flashy stock pickers you see on CNBC. They're the chess players who see moves decades ahead. They know that true diversification isn't slapping together a mix of equities and fixed income. That's an illusion.
When the economy hits the skids, and it always does eventually, stocks plummet, bonds yield less, and your so-called balanced portfolio turns into a house of cards. No, real protection comes from assets that dance to a different rhythm, one dictated by physics, not politics. Cat bonds are that rhythm. They're engineered to pay out handsomely unless a disaster hits, transferring the insurer's risk straight to investors like you or me, if we're bold enough. But here's where the intrigue deepens. This market isn't some sleepy backwater. It's exploding right under our noses. Fast forward to November 2025, and the total value of outstanding cat bonds has surged past $50 billion, a staggering 50% jump from just 5 years ago when it hovered at $33 billion. And the pace? It's relentless. In the past year alone, from August 2024 to July 2025, insurers pumped out a record $23 billion in new issuances. That's not growth. That's a financial avalanche. Why now, in this era of uncertainty? I've chased the threads across boardrooms and reinsurance giants, and three forces emerge, each more ominous than the last. First, the elephant in the room: climate change. It's not hype, it's happening. Storms are fiercer, wildfires rage longer, and floods swallow communities whole. Insurers are drowning in claims, their traditional safety nets of reinsurance buckling under the weight. So, they're turning to the capital markets, slicing up these mega risks into bonds that everyday investors can buy into. It's like crowdsourcing protection against Armageddon. Second, premiums are skyrocketing. As the risks mount, so do the costs. Homeowners pay more for policies, insurers charge more for coverage, and that flows straight into cat bond yields. We're talking coupons that can hit double digits in a bad year, luring in yield-starved investors like moths to a flame. And third, the 2022 wake-up call. Remember that year? Stocks and bonds tanked together in a rare double whammy, shredding the classic 60-40 portfolio by double digits. But cat bonds? They climbed 5%, a beacon in the gloom. Suddenly, the smart money, pension funds, endowments, sovereign wealth giants, realized these aren't gimmicks. They're the diversification holy grail, a shield against the economic correlations that bind everything else. Now, let's escalate this. Who's really fueling this boom? Not your corner broker, that's for sure. This is a sophisticated arena, dominated by the elite. Specialized funds like Fermat Capital, Planum Investments, and Stone Ridge lead the charge. These are hedge fund powerhouses laser-focused on insurance-linked securities, managing billions on behalf of the world's biggest institutions.
Take CalPERS, the California Public Employees Retirement System, one of the largest pension pools on the planet. They're in deep, allocating chunks of their trillions to cat bonds for that uncorrelated edge. Canadian pensions, European giants like the Dutch ABP, and even Middle Eastern sovereign wealth funds from places like Qatar and Abu Dhabi are following suit, treating these bonds as essential ballast. Multi-strategy hedge funds, the ones juggling stocks, rates, and commodities, are now carving out 5% to 10% of their portfolios for cat bonds. Think Citadel or Millennium, quietly hedging against the next black swan. Even the big asset managers are piling on. PIMCO, Amundi, BlackRock. They've all launched cat bond ETFs and funds, making this once arcane market accessible to high-net-worth clients. And in a twist that screams inside baseball, the reinsurers themselves are players on both sides. Swiss Re, Munich Re, they issue cat bonds to offload their risks, then turn around and snap up bonds from competitors, creating a web of mutual protection.
It's a closed-loop ecosystem worth tens of billions. Yet most retail investors, they've never even heard the term. That's the hidden warning. While you're chasing meme stocks or crypto dreams, the ultra-wealthy are fortifying against nature's fury, securing yields that laugh in the face of inflation. But the returns? That's the siren call that keeps me up at night. Since 1997, through booms and busts up to 2025, cat bonds have consistently outperformed their risk profile by about 4 percentage points annually. What does that mean? The yields they offer eclipse the expected losses from disasters by 4% on average. Investors get paid extra for stepping into the unknown, a fear premium, if you will, because cat bonds carry an aura of mystery. The market's still young, inefficient, with pricing quirks that savvy players exploit. Those who build sophisticated models, using satellite data, climate simulations, actuarial wizardry, can spot undervalued bonds and pocket excess returns. It's like arbitrage on apocalypse. Let me paint a vivid picture with a real-life thriller from 2011. Enter the Mariah Re bond, issued by American Family Mutual Insurance. This $100 million instrument was a gamble on America's heartland. It covered severe thunderstorms and tornadoes nationwide, promising investors a juicy 6.25% annual yield for shouldering the risk. The trigger? If industry-wide tornado losses topped $825 million in a year, poof, principal gone. On paper, it looked golden. Historical data showed such thresholds breached only once every 10 to 15 years. Steady income with a slim chance of catastrophe. Investors salivated. Then 2011 unfolded like a horror film. The U.S. endured its deadliest tornado season ever. Nearly 1,700 twisters, including the infamous Joplin outbreak, racking up $21 billion in damages. Industry losses? A crushing $9.5 billion. Wait, I misspoke earlier. It smashed right through that $825 million line. The bond triggered. Investors watched their $100 million evaporate in an instant. Heart-stopping stuff, right? The risk is visceral. Nature doesn't negotiate. Yet, zoom out, and the story flips. For those who diversified across a basket of cat bonds from 2010 to 2020, the average annual return hit 11%. Why? Most bonds sailed through unscathed, their high coupons compounding like clockwork. The rare triggers? Mere blips, more than covered by the winners. It's a probabilistic tightrope. Hold broad enough, and the math tilts in your favor. Losses sting, but they're sporadic, uncorrelated with the stock market's mood swings or real estate bubbles. No wonder pension funds are doubling down, ensuring retirees' nest eggs weather any storm, economic or literal. And billionaires? They see it as the ultimate hedge,
a way to sleep soundly while the world unravels. But in 2025, something seismic is shifting. And it's why this matters more urgently than ever. The cat bond market is evolving from its hurricane-heavy roots. Traditionally, 75% locked onto U.S. storm risks, Florida's coasts, Texas Gulf, the vulnerable underbelly. Now, issuance is splintering globally, chasing emerging threats. We're seeing bonds shield against earthquakes in Japan and California's fault lines, where a big one could cripple tech hubs and farmlands alike. Wildfires in California and Australia's outback torching billions in assets and water resources critical to agriculture. Floods ravaging Europe from the Rhine to the Thames, threatening supply chains that feed the world.
Even pandemic-linked mortality risks are entering the fray, a grim reminder of COVID's scars. And the issuers? No longer just reinsurance titans. Utilities, agribusiness use, sex. 1.5. Utilities, agribusiness conglomerates like those owned by the Resnicks, think vast California orchards and water pipelines, are dipping toes in, bundling disaster coverage for their sprawling empires. Governments and nonprofits are experimenting too, creating a broader, more resilient web. In a year when U.S. farmland faces drought-fueled wildfires and Midwest floods erode topsoil, these bonds aren't just finance. They're lifelines for food security and water rights. As climate chaos accelerates, this market's growth signals a deeper truth. The old rules of investing are obsolete. Ignoring cat bonds isn't just missing out. It's leaving your portfolio exposed to the one force no bailout can tame: nature's unscripted revenge. So, as we stand on the precipice of 2025, ask yourself, in a system rigged for the bold, are you still chasing yesterday's safe bets, or are you ready to embrace the storm? The billionaires already have. The question is, will you? Imagine this. In the dead of night, while the world sleeps, a handful of billionaires are quietly amassing invisible fortunes. Not in stocks or crypto, but in the very foundations of survival. Farmland that feeds nations, water rights that quench thirst in a parched future, and catastrophe bonds that bet against the apocalypse itself. What if I told you these aren't just investments? They're the ultimate shield against a crumbling financial empire, and the smart money is already circling like sharks before the storm hits. Let's pull back the curtain on what's really happening in the insurance world right here in 2025. You remember how catastrophe bonds started as this exotic tool, mostly cooked up by reinsurance giants to offload mega risks like earthquakes shaking California or wildfires torching the Australian outback. Well, the game's changing fast. Now, everyday insurers, the ones insuring your home and car, are stepping up to the plate themselves. Picture companies like Allstate, State Farm, and Farmers ditching the middleman and tapping straight into the capital markets. Last year, over half, 58% to be exact, of all cat bonds came from these primary players, a sharp jump from just 48% a couple years back. Why the shift? It's like watching an underground river burst to the surface. These bonds aren't some fringe experiment anymore. They're the new backbone of the entire insurance machine. When reinsurers were the only game in town, the market felt risky, opaque. But with primaries flooding in, liquidity surges, diversification spreads the bets thinner, and suddenly, investors aren't gambling. They're building infrastructure. It's deeper, more resilient, and that's catnip for the big fish. Think back to the early 2000s. Mortgage-backed securities were the hot, misunderstood ticket, promising juicy yields before they exploded into the mainstream,
And then the crisis. Cat bonds? They're at that exact inflection point now. High returns for the bold, but on the cusp of going prime time. Yields will compress as the crowd piles in, so the billionaires, they're loading up early before the retail rush dilutes the edge. But here's where it gets truly riveting. These aren't isolated plays. I want you to see the pattern I've uncovered, connecting cat bonds to something far more primal. American farmland laced with water access and the elusive water rights tied to it. Why these three? Because in a world teetering on scarcity, they're the unbreakable triad. Scarce as ancient relics.
You can't print more prime acres like those in the Midwest. Imagine this. It's 2025, and the taps in America's heartland are running dry. Not from drought alone, but from a silent war over the last drops of liquid gold, the Colorado River's fading flow. While you're watching stock tickers flicker, a handful of billionaires are quietly cornering the one resource that could dictate the future of empires: water. And they're not stopping there. They're stacking the deck with invisible shields against chaos, bonds that bet on catastrophe itself. What if I told you the ultra-wealthy aren't chasing quick profits anymore? They're preparing for the collapse of everything you thought was safe. Buckle up, because today, we're pulling back the curtain on how the elite are rewriting the rules of wealth in a world on the brink. Let's start at the source, right here in the dusty plains of the American Midwest, where the sun-baked soil hides a fortune bigger than Silicon Valley's dreams. Picture vast stretches of farmland, not just dirt and crops, but lifelines to survival. For years, I've watched the markets dance to the tune of tech bubbles and crypto highs. But something's shifted. The smart money, the kind that built fortunes from nothing, is flowing into the ground. Not stocks, not crypto, but the very earth that feeds us. And at the center of it all, water rights. Senior claims to the rivers and aquifers that could vanish as climate chaos intensifies. It's not sexy, it's not viral, but it's the ultimate hedge against an unraveling system. To understand how we got here, rewind a decade. Back in the early 2000s, a visionary tech mogul named Bill Gates began his quiet conquest. He wasn't planting widgets or coding software anymore. He was acquiring acres upon acres of prime U.S. farmland. Over 12 methodical years, he pieced together what would become the largest private farmland portfolio in America. 270,000 acres across 19 states. Why? Because farmland isn't just about corn and soybeans. It's about control. Embedded in those deeds are water rights, the legal golden tickets to divert rivers and pump groundwater without apology. Gates saw it coming. Population booms, endless droughts, and a global food chain stretched thin. He didn't announce it with fanfare. He just bought, piece by piece, while the world scrolled past. But Gates isn't alone in this shadowy game. Enter T. Boone Pickens, the oil wildcatter turned water baron. In the sweltering Texas panhandle, he transformed his Mesa Vista ranch into a water empire. By 2011, he'd secured rights to pump over 65 billion gallons a year from the Ogallala Aquifer, one of the world's largest underground reservoirs. Valued at $500 million today, those rights weren't a lucky find. Pickens scouted them when water was still cheap and plentiful, before the headlines screamed scarcity. He sold off his energy stakes to double down, piping water to thirsty cities like Amarillo. It was a masterstroke, turning a depleting resource into a steady revenue stream, all while the rest of Wall Street bet on fracking booms. And then there are the Resnicks, the power couple behind the wonderful company.
owners of Fiji Water and Palm Wonderful. They didn't stop at bottling. They went straight for the source. In California's sun-drenched Central Valley, they've amassed 180,000 acres of almond orchards and pistachio groves backed by ironclad water allocations from the state's labyrinthine system. Stuart and Linda Resnick aren't philanthropists. They're strategists. Their empire guzzles billions of gallons annually, secured through political savvy and deep pockets.
As California's reservoirs shrink, down 50% in the last decade, their holdings ensure their crops thrive while competitors wither. It's a microcosm of the bigger play. In a nation where 40 states face water stress, owning the flow means owning the future. Now, you might be thinking, that's all well and good for billionaires with private jets, but how does this touch the average investor? Here's where it gets intriguing and a little unnerving. The ultra-wealthy aren't hoarding these assets in isolation. They're signaling a seismic shift in how wealth is preserved. Farmland with embedded water rights isn't about yield curves or dividends. It's about sovereignty. When supply chains snap and borders tighten, the land that produces food becomes priceless. But direct ownership? That's locked behind legal fortresses. Decades of negotiations, state-specific laws, and prices skyrocketing into the millions per acre. Enter the proxies. Exchange-traded funds that let you ride the wave without the hassle. Take the water sector, for instance, building on the scarcity play we discussed earlier with companies like Xylem and their cutting-edge pumps. The Invesco Water Resources ETF, trading under the ticker PHO, bundles it all together. A diversified basket of utilities, infrastructure giants, and tech innovators poised to profit as taps run low. We're talking firms that build dams, treat wastewater, and meter every drop. It's not a direct stake in Colorado River rights. No, that's still the holy grail for the elite. But it's tightly linked to the same inexorable trend. As droughts multiply and regulations tighten, these companies see revenues surge. PHO has quietly delivered double-digit annual returns over the past 5 years, outpacing broader markets during water crises. It's exposure without the courtroom battles. But the real intrigue ramps up when we talk catastrophe. Because water scarcity doesn't strike alone. It rides in on the coattails of wildfires, floods, and hurricanes. Events that are no longer if, but when. Pension funds and hedge funds have known this for years, pouring billions into an arcane asset class, catastrophe bonds, or cat bonds. These are high-stakes instruments where investors lend money to insurers, earning juicy yields if disasters don't materialize. If a megastorm hits, the principal gets wiped to cover claims. But in calm years, returns can top 6 to 8%. It's like insurance for the insurers, and it's exploding as climate risks mount. The catch? Individual investors couldn't touch them directly. Until now. Mutual funds and ETFs have democratized the door, wrapping these bonds in accessible packages. Consider the Stone Ridge High Yield Reinsurance Risk Premium Fund, ticker SHRIX. It dives deep into cat bonds and insurance-linked securities, offering a slice of that institutional action with just a $1,000 minimum on many platforms. Or the Pioneer Cat Bond Fund, ticker CBYX, another mutual fund laser-focused on this niche. These aren't your grandma's bond funds. They provide daily liquidity and spread risk across dozens of global events, from California wildfires to Atlantic hurricanes. Fees? Yeah, they sting at 1 to 2% annually, chipping away at gains. But you're buying expertise and diversification that solo players can't match. For broader strokes, track the Swiss Re Cat Bond Index through ETFs like the one from CraneShares or similar vehicles, giving you the market's pulse without picking winners. Returns average 4 to 6% with lower volatility than single bonds, a buffer against the wild swings of disaster seasons. It's not glamour, it's grit. And as 2025 unfolds with record heat waves and supply disruptions, these instruments are flashing green. Payouts held steady even as traditional bonds tanked in 2022. Why does this matter now, in this exact moment? Because the cracks are widening. Look at 2022. Markets hemorrhaged trillions as inflation raged and diversification myths shattered. Stocks and bonds, the old reliables, moved in lockstep. Down together, no escape. Pension funds didn't pivot to cat bonds out of whimsy. Their algorithms screamed for uncorrelated assets, ones that thrive when the world burns. Farmland? It posted positive returns amid the chaos, anchored by water's unyielding demand. Water rights? Their value doubled in arid states like Arizona and Nevada. Fast forward to today. Global water demand is projected to outstrip supply by 40% by 2030, per the UN. Farmland prices have surged 20% year over year in water-rich regions. Cat bond issuance hit $15 billion last year, the highest ever. The billionaires aren't guessing. They're acting on data we can all see. Bill Gates expanded his holdings amid the pandemic, betting on food security when borders slammed shut. T. Boone Pickens' water pipeline now supplies a quarter of Amarillo's needs, a lifeline in Texas's escalating dry spells. The Resnicks? Their orchards pumped out $4 billion in revenue last year, untouched by the volatility hammering tech peers. This isn't hyperbole. It's history repeating. Every empire's fall, from Rome's aqueducts to the Dutch tulip crash, saw the elite flee paper wealth for tangibles. Reserve currencies collapse, but food grows, water flows, and risk can be traded. In 2025, with U.S. debt at 130% of GDP and climate migrants swelling, the unsustainable system Gates, Pickens, and the Resnicks are evading feels closer than ever.
They're not chasing 20% pops. They're fortifying for regime change. The shift from fiat fragility to resource resilience. So, as we wrap this investigation, let me leave you with a mirror. These assets, watertied ETFs like PHO, farmland proxies, cat bond funds like SHRIX and CBYX, aren't secrets anymore. They're accessible if you're willing to look beyond the headlines. But heed this. I'm not your advisor. This isn't a buy signal. It's a spotlight on patterns the powerful ignore at their peril. Billionaires like Gates didn't amass empires by accident. They positioned early, systematically, for the storms others deny. The question hanging in the air? Will you see the trend before the scarcity hits home? Food, water, disaster shields. These are the new gold. Not because they sparkle, but because they sustain. In a world remade by limits, the ones who control the essentials won't just survive, they'll redefine wealth. The clock's ticking. What's your move?